Every single week, somewhere on the internet, someone posts a photo of themselves in front of a nice house with a caption that says something like, "Just closed on my third investment property at 27. Real estate changed my life. Here's how you can do it too." And every single week, somewhere that you don't see on the internet, another landlord is dealing with a tenant who hasn't paid rent in 4 months, a boiler that just broke down and needs a $5,000 replacement, and a property that's been sitting vacant for 2 months while the mortgage still needs to be paid. Both of these stories are real. Both of them are happening right now to real people. Here's the problem. The real estate industry, the agents, the coaches, the gurus, the influencers, has a massive financial incentive to show you the first story and hide the second one. Because excited buyers are profitable. Cautious, informed buyers ask too many hard questions. I have no financial incentive here. I'm not selling you a course, I'm not a real estate agent, and I don't get a commission if you buy a property. What I am going to do is give you the complete picture, every genuine advantage that makes real estate one of the most powerful wealth-building tools in history, and every genuine disadvantage that turns it into a financial nightmare for people who weren't properly prepared. Stay until the verdict at the end, because I'll give you a specific framework to decide whether real estate is actually the right investment for your personal financial situation. Not a generic answer, your situation. Let's get into it. Before we get into advantages and disadvantages, let's make sure we're talking about the same thing, because real estate investing is not one thing. It's a category that contains several very different strategies with very different risk and reward profiles. Residential rental properties, buying houses or apartments and renting them to tenants, is what most people picture when they think of real estate investing, and it's what we'll focus on most in this video. But real estate investing also includes commercial properties, office buildings, retail spaces, warehouses. It includes house flipping, buying undervalued properties, renovating them, and selling quickly for a profit. It includes REITs, real estate investment trusts, which allow you to invest in real estate portfolios through the stock market without owning any physical property. And it includes vacation rentals, development projects, and land investment. Each of these has its own specific advantages and disadvantages. For this video, we'll focus primarily on the direct ownership of residential rental property, because that's the entry point for most individual investors and where the most important decisions get made and the most serious mistakes get made. Now let's talk about why real estate has made more ordinary people wealthy than almost any other investment class in history. Let's start with the most talked about advantage of real estate investing, and the one that deserves the most careful examination: passive income. The idea is simple. You buy a property, you rent it to a tenant, the tenant pays rent every month. That rent covers your mortgage payment, your property taxes, your insurance, and your maintenance costs, and whatever is left over is your profit. Month after month, year after year, whether you're working or sleeping. This is the dream, and it's a legitimate dream. It actually works this way for many investors. But the word passive needs serious examination because real estate income is rarely as passive as it's made to sound. In the best case scenario, a well-maintained property in a strong rental market with a reliable long-term tenant managed by a professional property manager, yes, the income is largely passive. You check in periodically, your property manager handles day-to-day issues, and cash flows into your account. In a more typical scenario, especially for new investors who self-manage their properties, the income is passive until it isn't, until the boiler breaks, until the tenant stops paying, until the roof develops a leak, until you need to find a new tenant. In these moments, real estate demands significant time, energy, and money. The cash flow advantage is most powerful when you have the right property in the right market with conservative financial assumptions built in. The investors who get into trouble are typically the ones who bought in markets where rents barely cover costs, left no financial buffer for vacancies and repairs, and discovered that the real numbers were nothing like the optimistic projections they ran before buying. The key metric to understand is this. Before you buy any rental property, calculate your net cash flow after every expense: mortgage, taxes, insurance, property management fees, estimated maintenance, budget at least 1 to 2% of the property's value per year, and a vacancy allowance of at least 5 to 10% of annual rent. If the number is still positive after all of that, you have a property with genuine cash flow potential. Advantage 3. The power of leverage. 9:30 to 12:30. This is the advantage that genuinely separates real estate from most other investment classes, and it's the one that real estate wealth building stories are almost always built on, even when people don't fully explain it. Leverage means using borrowed money to amplify your investment returns. In real estate, this typically means using a mortgage to buy a property worth far more than you could afford to buy outright. Here's a simple example that illustrates why this is so powerful. Suppose you have $50,000 to invest. If you put that $50,000 directly into the stock market and earn a 10% return, you make $5,000. Your return on your initial capital is 10%. Now suppose instead you use that $50,000 as a down payment on a $250,000 property. The bank lends you the other $200,000. In the first year, the property appreciates by 5%, a much lower return than our stock market scenario. 5% of $250,000 is $12,500. Your return on your initial $50,000 capital is 25%, more than double the stock market scenario, even though the actual percentage gain on the property was lower. This is the magic of leverage. You're earning a return not just on the money you put in, but on the total value of the asset, most of which was financed with the bank's money. Add rental cash flow on top of this appreciation, factor in the mortgage principal being paid down by your tenant's rent each month, and the total return on invested capital from a well-chosen leveraged real estate investment can be genuinely extraordinary. The critical warning: leverage amplifies losses just as powerfully as it amplifies gains. If that same $250,000 property drops in value by 20%, which absolutely happens, you lose $50,000, your entire down payment. Your initial capital is completely wiped out, even though the property only dropped 20% in value. This is how people lose everything in real estate during downturns. They were highly leveraged going in, values dropped, and they couldn't cover their mortgages. Leverage is a tool. In skilled hands, it's enormously powerful. Used recklessly, it's catastrophic. Advantage number 4: tax benefits and deductions. Governments in most countries have historically provided significant tax advantages to property investors, advantages that are simply not available to stock market investors. Understanding these benefits is one of the most important parts of real estate investing. The specific benefits vary by country, but in most major real estate markets, they include several powerful mechanisms. Mortgage interest deduction. In many countries, you can deduct the interest you pay on your investment property mortgage from your taxable income. In the early years of a mortgage, when interest payments are highest, this can represent a substantial tax saving. Depreciation. This is one of the most powerful and least understood tax advantages in real estate. Even though your property is likely appreciating in real-world market value, tax authorities in many countries allow you to deduct a portion of the building's value each year as a depreciation expense. This is a paper expense. You didn't actually spend that money, but it reduces your taxable income, meaning you pay tax on less of your rental income than you actually received. This is a legal mechanism that allows many real estate investors to pay remarkably low effective tax rates on their rental income. Operating expense deductions, property taxes, insurance, property management fees, repairs and maintenance, professional fees, all of these are typically deductible against your rental income. Capital gains treatment. In many countries, when you eventually sell an investment property, the profit is taxed at a lower capital gains rate rather than as ordinary income. Some countries provide additional exemptions or deferrals for property sales under specific conditions. The cumulative effect of these tax advantages can significantly improve your real return on real estate investment compared to assets that don't carry these benefits. But, and this is critical, tax laws change. Benefits that exist today may not exist in 5 years. Always consult a qualified tax professional who specializes in real estate before making investment decisions based on tax assumptions.
Advantage number 5, real estate as an inflation hedge. One of the most important and most underappreciated advantages of real estate investing is its relationship with inflation. Inflation, the gradual increase in the price of goods and services over time, is devastating to cash savings. Money sitting in a bank account earning 2% interest while inflation runs at 4% is actually losing purchasing power every year. This is why financial advisors universally recommend investing rather than simply saving. Real estate is one of the most effective inflation hedges available to individual investors for several interconnected reasons. First, property values tend to rise with inflation. The cost of building materials, labor, and land all increase with inflation, which means the replacement cost of your property increases and market values tend to follow. Second, rental income also tends to rise with inflation. When the cost of living increases, landlords can typically raise rents, and in strong rental markets, rent increases often match or exceed inflation. This means your income stream from the property maintains its real purchasing power over time. Third, your mortgage payment is fixed in nominal terms. If you have a fixed-rate mortgage, your monthly payment stays the same in dollar terms, even as inflation erodes the real value of that debt. What feels like a large monthly payment today will feel much smaller in real terms in 20 years. Effectively, inflation is helping you pay off your mortgage. These 3 factors, appreciating asset value, inflation matching income, and deflating real debt burden, combine to make real estate one of the most powerful inflation protection tools available. In periods of high inflation, like many countries experienced in 2022 and 2023, real estate investors with fixed-rate mortgages and strong rental markets often saw their financial position improve in real terms, even while inflation was hammering everyone else's purchasing power.
Advantage number 6, a tangible asset you can control. Here's an advantage that doesn't show up in any financial spreadsheet, but that matters enormously to many investors. Real estate is real. You can see it, touch it, walk through it, and drive past it. It exists in the physical world in a way that stocks and bonds do not. This tangibility carries several genuine advantages. You have direct control over your investment in a way that you simply don't have with stocks or funds. You can make improvements that increase its value. You can choose your tenants. You can decide when and whether to sell. You can refinance to access equity. You can change its use within zoning limits. A stockholder has no such control over the companies they invest in. You can buy and sell shares, but you cannot walk into Apple headquarters and tell them how to run the business. The tangible, controllable nature of real estate also provides a psychological anchor during market downturns. When stock markets crash by 30%, many investors panic sell at exactly the wrong time, crystallizing massive losses because they see the number falling on their screen every day and the fear becomes overwhelming. Property investors during downturns often find it much easier to hold because the property is still there, the tenant is still paying rent, and the decline in market value feels less visceral because there's no daily price ticker screaming at you. There's also a permanence to property ownership that carries genuine value for many people. Real estate can be passed to future generations. It can be used personally if circumstances change, converted to a primary residence, used as a family home, or repurposed. It has uses beyond just investment returns.
Advantage number 7, multiple streams of income from one asset. Most investments generate returns in one way, price appreciation or income payments, or both. Real estate is unusual in that a single property can generate returns through multiple simultaneous mechanisms, making it uniquely powerful as a wealth-building tool. Consider what a single well-chosen rental property can do simultaneously. It generates monthly rental income, cash flow directly into your account. It appreciates in market value over time, building equity you can access through sale or refinancing. Your tenants' rent payments pay down your mortgage principal every month, increasing your equity even if the market price doesn't move. The tax advantages we discussed, depreciation, expense deductions, mortgage interest deductions, reduce your tax burden, keeping more of your income. And if you make strategic improvements, a kitchen renovation, added bathroom, improved landscaping, you can force appreciation beyond what the market alone would provide.
No other common investment vehicle offers this many simultaneous return mechanisms from a single asset. A stock pays dividends and appreciates, 2 mechanisms. A bond pays interest, 1 mechanism. Real estate, managed well, can generate returns through 5 or 6 different channels at once. This multi-stream return profile is what allows experienced real estate investors to generate returns that look extraordinary compared to traditional asset classes, even when any single one of these mechanisms is performing only moderately.
Advantage 8. Long-term wealth building and generational wealth. The final advantage on our list is the biggest picture of all, and it's the reason real estate has been central to wealth-building strategies across cultures and throughout history. Over long enough time periods, 15, 20, 30 years, a well-managed portfolio of investment properties in solid markets has the potential to generate life-changing generational wealth. Not because any individual year's returns are spectacular, but because of the compounding effect of simultaneous appreciation, debt paydown, rental income, and tax advantages working together over decades. Consider a simplified example. An investor buys a $300,000 property with a $60,000 down payment. Over 25 years, the property appreciates to $750,000. The mortgage is paid down, primarily by the tenant's rent, to near zero. The investor's initial $60,000 has grown to $750,000 in equity, plus decades of cash flow income, plus tax savings over that period. Multiply this by even a small portfolio of 2 or 3 properties, and you begin to understand how ordinary people, teachers, nurses, small business owners, have built 7-figure net worths through real estate, not through spectacular investment genius or unusual risk-taking, but through patience, discipline, and time. Real estate is also one of the most transferable forms of wealth. Property can be left to children and grandchildren, providing financial security across generations. Unlike stock portfolios that can be liquidated quickly in times of need, the physical permanence of property can make it more likely to be preserved and passed on intact. This is the deepest case for real estate as an investment, not what it does for you in any given month, but what it does for your financial position over the arc of a lifetime. Okay, that's the case for real estate. Now let's talk about why it's also sent thousands of investors into financial crisis.
Disadvantage number 1, high upfront capital requirements. Let's start with the barrier that stops most people from ever getting into real estate investing at all. You need significant money to begin. Unlike stocks, where you can start investing with $100 or even $10 through fractional shares, real estate requires substantial upfront capital. In most markets, a mortgage on an investment property requires a down payment of 15 to 25% of the purchase price, because lenders charge higher rates and require larger down payments for investment properties than for primary residences. On a $300,000 property, that's $45,000 to $75,000 in down payment alone. Add closing costs, typically 2 to 5% of the purchase price, and you're looking at $51,000 to $90,000 before you own a single property. And that's before any repairs, renovations, or initial setup costs. In expensive markets, major cities in the US, UK, Australia, and Canada, where median property prices often exceed $600,000 or $700,000, the upfront capital required is dramatically higher. Many people in these markets are effectively priced out of direct real estate investing entirely, unless they inherit capital or can leverage equity from a primary residence they already own. The capital requirement also creates concentration risk from the beginning. Putting $60,000 into a single down payment on a single property concentrates a large portion of many people's investable savings into a single asset in a single location. Diversification, the fundamental principle of risk management and investing, is very difficult to achieve in real estate without substantial capital. This is one of the primary arguments for REITs, real estate investment trusts, as an alternative. REITs allow you to invest in diversified real estate portfolios with any amount of money through the stock market with full liquidity, but they come with their own trade-offs, which we'll touch on in the disadvantages section.
Disadvantage number 2, illiquidity, the danger of not being able to sell fast. This is perhaps the most dangerous disadvantage of direct real estate investment, the one that can turn a temporary financial problem into a catastrophic one. Real estate is illiquid. Unlike stocks, which you can sell within seconds at any time the market is open, property takes time to sell, typically weeks to months in normal market conditions, and potentially much longer in slow or declining markets. The selling process involves listing the property, finding a buyer, negotiating, completing due diligence, and going through a legal closing process that varies by country, but is rarely quick. In a slow market, or when you're under financial pressure and need to sell quickly,
Illiquidity is devastating. A desperate seller gets desperate prices. If you must sell within 30 days to cover a financial emergency, you're at the mercy of whatever buyers are in the market at that moment, in that condition, at that price point. This illiquidity has several practical implications that every real estate investor needs to understand deeply. Your cash reserves matter enormously. Before buying an investment property, you need to maintain significant liquid savings, not invested in the property, accessible immediately, to cover unexpected expenses, vacancy periods, and personal financial emergencies. Most experienced investors recommend maintaining 3 to 6 months of property expenses in liquid reserves, plus a separate personal emergency fund. Your exit timeline must be realistic. If your investment thesis requires selling within a specific short time frame, to fund a child's education in 5 years, to cover a business need, real estate may be the wrong vehicle. You cannot guarantee a timeline for selling at an acceptable price, and your ability to withstand temporary downturns is critical. When property values declined 30 to 40% in some markets during the 2008 crisis, investors who had liquid reserves and didn't need to sell were able to hold through the decline and eventually recover. Investors who were forced to sell because they had no cash reserves, or had lost their jobs, or had over-leveraged their portfolio, locked in catastrophic losses. Illiquidity is not necessarily a reason to avoid real estate, but it must be factored into every investment decision, and it requires significantly more conservative financial planning than liquid investments.
Disadvantage number 3. Hidden costs and ongoing expenses. This is the disadvantage that catches new real estate investors off guard more consistently than any other. The total cost of owning and maintaining investment property is almost always significantly higher than projected. Let's go through the real cost categories that first-time investors frequently underestimate. Maintenance and repairs. The standard rule of thumb is to budget 1 to 2% of the property's value per year for maintenance and repairs. On a $300,000 property, that's $3,000 to $6,000 per year, or $250 to $500 per month. New investors frequently budget nothing or far too little for this, then find themselves financially strained when unexpected repairs occur. And unexpected repairs will occur. They always do. Plumbing fails, electrical systems age, appliances break, roofs leak, HVAC systems fail, often in the worst weather. Property management fees. If you use a professional property manager, which we'll discuss in the management section, expect to pay 8 to 12% of monthly rent in management fees, plus additional fees for tenant placement, lease renewals, and maintenance coordination. On a $1,500 per month rental, that's $120 to $180 per month in management fees alone. Vacancy costs. No property is rented 100% of the time. Tenants leave, properties need to be cleaned and repaired between tenants, and it takes time to find qualified new tenants. A conservative vacancy allowance of 5 to 10% of annual rent is standard. On a property renting for $1,500 per month, that's $900 to $1,800 per year that you should plan not to receive. Insurance. Investment property insurance is more expensive than homeowners insurance, and in high-risk areas, flood zones, hurricane zones, high-crime areas, the premiums can be significant. Property taxes. These vary dramatically by location and can change over time. Some municipalities regularly reassess property values and adjust taxes upward accordingly. Capital expenditure reserves. Beyond routine maintenance, every property needs major capital expenditures at predictable intervals. New roof every 20 to 30 years, HVAC system replacement every 15 to 20 years, water heater replacement every 10 to 15 years, exterior painting every 5 to 10 years. These costs are predictable, the timing is not. Experienced investors set aside a capital expenditure reserve each month to fund these inevitable major expenses. When you add all of these costs together and subtract them from rental income, the cash flow of many investment properties, particularly those bought in expensive markets at high prices, narrows dramatically or disappears entirely. This is not a reason to never invest in real estate, but it's a reason to run detailed, conservative numbers before you buy rather than optimistic ones after. So, is investing in real estate worth it? After examining every advantage and every disadvantage, here's the honest verdict. Real estate is one of the most powerful wealth-building tools in history, and it's also one of the most effective ways to create financial stress, wasted capital, and personal headaches if approached with adequate preparation, capitalization, and patience. The difference between investors who build genuine wealth through real estate and those who struggle is not primarily about market timing or finding magical undervalued deals or having some special insight. It's about doing the boring fundamental work, running truly conservative financial projections that include all real costs, maintaining adequate liquid reserves, buying in markets with genuine long-term demand, being patient enough to hold through market cycles, and treating it like the business it is, not a passive income machine that runs itself. Real estate investing is most likely right for you if you have adequate capital for a down payment plus substantial liquid reserves.
If you have a long enough investment horizon, 10 years minimum, 20 or more ideally. If you have the temperament to manage tenant relationships and property challenges with significant stress. If your market offers genuine positive cash flow after all realistic expenses, and if real estate fits as one component of a broader, diversified financial strategy rather than your entire investment approach. Real estate investing is less likely right for you if your capital is limited enough that one unexpected major expense would create serious financial strain. If you need liquidity, the ability to access your capital quickly in an emergency. If you have a short investment timeline. If the markets you can realistically access don't offer positive cash flow at current prices, or if the management demands of being a landlord are genuinely incompatible with your life circumstances. There is no universal right answer. Real estate has genuinely made ordinary people extraordinarily wealthy. It has also genuinely destroyed the finances of people who went in underprepared, overextended, and with unrealistic expectations. Go in with clear eyes, and if the numbers work, the timeline works, and the temperament works, it may be one of the best financial decisions you ever make.
That's the complete picture. Every advantage, every disadvantage, and an honest framework to help you decide whether real estate investing fits your situation. Before you go, I want to hear from you. Are you currently investing in real estate? Are you thinking about it? What's your biggest concern after watching this video? Or what's the advantage that excites you most? Leave a comment below. Your experience helps everyone watching. If you want to go deeper, we have videos on specific real estate strategies, how to analyze a rental property deal, and the advantages and disadvantages of REITs versus direct property ownership. Check those out next. And if you haven't subscribed yet, hit subscribe. We make videos like this every week, giving you the honest, complete picture on the financial decisions that matter most. See you in the next one.